Welcome, curious minds. Today, we're doing a deep dive into the financial world.
Hmm.
Specifically, we're looking at the recent second quarter 2025 earnings of East West Bancorp.
That's right.
We've got their official earnings call transcript, the news release, all that good stuff. And our mission for you, really, is to cut through the numbers, the jargon.
Yeah, get past the noise.
Exactly. We want you to walk away understanding not just what happened, but, why it matters. Why it matters to the bigger economic picture, and maybe even to you.
Sort of your shortcut to being genuinely informed.
That's the goal.
Absolutely. And we'll be synthesizing quite a bit here, looking for those patterns, connecting the dots.
Right.
The idea is to highlight the key performance indicators, the KPIs, that really show the bank's operational health, its strategic direction. You kind of see how solid financial management plays out, in real time.
Even with everything shifting in the economy.
Especially that.
Okay, let's unpack this then. Starting right at the top, East West Bancorp reported a really strong second quarter for 2025.
Definitely strong headline.
They hit record quarterly revenue and record net interest income. When you see numbers like that, records being broken, what does that immediately signal?
Well, it signals a bank that's clearly doing something right, in a solid position.
Yeah.
But what's really interesting here, I think, is the combination of things driving that record revenue.
It wasn't just one thing.
No, not at all. The growth wasn't just siloed in one area. Both loans and deposits showed pretty solid average growth, about 2% quarter over quarter.
Okay.
And that points to, a balanced approach, a relationship-driven model that's working for both their commercial side and their consumer clients. It's balanced growth across the board.
And it wasn't just about growing, right? It was like profitable growth.
Exactly. Highly profitable. We're talking a reported 16.7% adjusted return on tangible common equity.
That sounds high.
It is. And a 1.6% return on average assets. Plus, and this is key, their asset quality stayed strong. Resilient.
So fewer problem loans.
Right. Both criticized loans and non-performing loans actually decreased from the first quarter, which is, a good sign in any environment.
So how does a bank manage that? Achieve such consistent performance?
Well, that raises a good question. The source material points out their tangible common equity, which is essentially their core capital cushion.
Like the real bedrock capital.
Pretty much, yeah. It's sitting around 10%. That shows a very strong capital base.
Okay.
And get this, for the third year in a row, and the fourth time in the last 5 years, East West Bank was ranked by Bank Director magazine as the #1 performing bank.
Number one
Among banks with over $50 billion in assets.
Wow.
That kind of achievement, it's not luck. It really speaks to consistent execution, a strong focus on their customers. It suggests they've built something pretty durable.
Okay. That's a powerful track record. So those are the headlines. Strong revenue, top rankings. Let's get into the nitty-gritty. How do they actually do it? The core banking stuff.
Right.
Deposits and loans.
Right, the fundamentals.
Looking at deposits first. Total average deposits grew 2% quarter over quarter, and end-of-period deposits were up 3%.
And what's fascinating here is the quality of that deposit growth. It wasn't just hot money chasing rates.
Okay, what do you mean by quality?
Well, they saw strong increases in non-interest-bearing deposits.
Free money.
Exactly. Money they don't have to pay interest on. That's huge. But they also saw growth in their interest-bearing checking, money market, and time deposit balances, too.
So diverse growth.
Yeah, very diverse.
Yeah.
And that chunk of non-interest-bearing accounts especially is a real positive sign for their cost of funds. Actually, non-interest-bearing deposits made up 24% of their total deposits at the end of June 2025.
24%. That's significant.
It really is. Shows customer trust, stickiness.
So what does this mean for you, the listener? Well, it sounds like they're not just grabbing new customers off the street.
No, it's deeper than that.
They're actually strengthening relationships with the ones they have across commercial, consumer, business banking, all segments.
And the bank expects those customer deposits to keep funding their loan growth this year. It's a sustainable model.
Okay, so let's flip to the other side of the balance sheet, the loans.
Right. Average loan balances were up, $940 million quarter over quarter. Hit a record $55.0 billion.
Another record. And where did that growth come from mostly?
Commercial and industrial lending, C&I, was the biggest driver.
So loans to businesses.
Yeah, for operations, expansion, working capital, that sort of thing. New loans came from a really broad range of industries, which is good diversification. And importantly, how much businesses were drawing down on existing credit lines. That utilization rate it's stayed stable.
Okay, so businesses are borrowing, but not like in a panic.
Seems steady, yeah.
Yeah.
And the pipeline, what they expect in Q3 for C&I, looks pretty active too.
And it wasn't just C&I, right? You mentioned other areas.
Correct. Demand for residential mortgages actually proved relatively durable. Still decent demand there.
Even with higher rates.
Apparently so. They have a strong pipeline expected for Q3 there as well. And they even saw some modest growth in commercial real estate balances too.
Hmm. So it sounds like they're deliberately not putting all their eggs in one basket.
Exactly. If you connect this to the bigger picture, the strategy they've talked about, they're actively working towards balancing that loan portfolio.
How so?
They're aiming for roughly, one-third C&I, one-third single-family residential mortgages, and one-third commercial real estate over the medium to long term.
Okay, a three-legged stool kind of approach.
Sort of, yeah. It spreads the risk. And they're making steady progress towards that balance. It shows, I think, some thoughtful long-term planning.
Okay, so growth looks good, seems balanced. What about the other financial health metrics, the internal checks?
Yeah.
Net interest income, that's always a big one.
Crucial one. It grew to $617 million. That's up $17 million just from Q1.
Nice jump. Yeah. And what's really impressive, maybe even more so, is this growth happened even as they successfully lowered their interest-bearing deposit costs.
Lowered costs while growing income? How?
They brought those costs down by 67 basis points since the rate-cutting cycle supposedly started, which actually beat their own internal guidance. They were aiming for a 50% beta.
Okay, beta. That sounds technical. What's that mean in simple terms?
It's basically how much or how fast they expected their deposit costs to fall relative to overall market rates. So beating that 50% target, getting a 67 basis point drop instead, means they outperformed their own expectations in lowering costs.
Wow. So they're managing costs really effectively.
Extremely effectively.
Right.
Especially with things like CDs, they're pricing in what they expect future rates to do. It lets them lower deposit costs now, anticipating those future rate cuts, even though the Fed's been maybe a bit slower than expected. Very shrewd management.
And it wasn't just interest income, right? You mentioned fees earlier. Right. Solid fee income, too. $81 million in the quarter, which was the third highest quarter for fees in the bank's history.
So they're really pushing on diversifying revenue beyond just lending.
Definitely looks like a focus area. Makes sense.
Okay, let's talk risk. Asset quality, you said it was resilient.
Yeah, the metrics here continue to look, frankly, better than a lot of the industry. Criticized loans, those are loans showing some potential weakness. They decreased by 14 basis points down to 2.15% of total loans. And non-performing assets, the really troubled stuff, down 2 basis points to just 0.22% of total assets. Very low.
And charge-offs were actual losses.
Also remained low, just $15 million, which annualizes to only a 0.11%. So, yeah, the current picture looks very healthy on the credit front.
But then here's something that might make you pause. Why did their allowance for loan losses, the money set aside for future potential losses, why did that increase by $25 million? It's now $760 million, or 1.38% of loans. Seems counterintuitive if everything looks so good now.
That is a great question, and it gets right to their forward-looking risk management approach.
Okay.
That increase wasn't because of specific problems they're seeing right now in their C&I loans or anything like that.
Mm-hmm.
No, it was driven by their CECL model.
CECL. Current expected credit loss.
Exactly. Think of it as a required accounting standard where banks have to forecast potential future losses based on economic outlooks, not just current conditions.
So it's about the forecast.
Precisely. The model incorporates various economic forecasts, including one from Moody's, and apparently the Moody's model showed some, let's say, slight degradation in the overall economic outlook.
Oh, okay.
So East West prudently factored that slightly less rosy general outlook into their calculations across multiple scenarios.
Mm-hmm.
It's basically them being conservative, saying, even though our portfolio looks great now, the broader forecast has a bit more uncertainty, so we'll set aside a little extra cushion just in case.
Proactive, not reactive.
Exactly. It speaks to a conservative approach to credit risk.
And what about overall capital, their safety net?
Exceptionally strong. Their common equity tier 1 capital ratio, that's the highest quality capital,
Right.
it actually rose to 14.5%.
14.5%. That's way above the minimums, isn't it?
Way above. Puts them among the best capitalized banks in the industry. And their tangible common equity ratio, which we mentioned earlier, also rose to 10%. Very solid footing.
Okay, so putting it all together, strong results, good risk management, solid capital. What does this mean for the rest of the year? What's their outlook?
Well, they updated their full-year outlook. They're now expecting end-of-period loan growth to be somewhere in the 4% to 6% range for the full year.
Still solid growth then.
Decent growth, yeah. And maybe even more notably, they see both net interest income and total revenue trending above 7% growth for the full year 2025.
Above 7%. That's strong guidance.
It is. And if you connect that back to the bigger picture, remember they're what's called an asset-sensitive bank. Meaning basically that their assets, loans, reprice or benefit more quickly from rate changes than their liabilities deposits. So if the Fed ends up cutting rates fewer times or slower or later than expected,
Which seems possible.
right, that could actually lead to even better performance for them. Their loan income stays higher for longer while they're already managing deposit costs down.
Interesting. So slower cuts could be good news for them, relatively speaking.
Could be, yeah. Alongside that continued loan growth funded by those strong deposit inflows we talked about, they also adjusted their outlook on charge-offs, expecting them to be lower now, between 15 and 25 basis points for the year. All points to confidence.
Okay, one area that always comes up, especially for a bank like East West, with its, unique history and customer base connecting the U.S. and Asia,
Right, the cross-Pacific focus.
is global trade.
Yeah.
Tariffs. Did the earnings call give any flavor for how their clients are feeling about that whole situation?
Yeah, that was interesting. There was some insight from the CEO on client sentiment about tariffs.
They're still big worry.
Well, while there's still obviously some uncertainty out there, the message was that clients are reportedly becoming maybe more comfortable with the idea that tariffs are just going to be a feature of the landscape.
Like accepting reality.
Kind of. They seem to have more certainty now compared to, say, the beginning of the year. Plus, apparently many products are exempted anyway, and businesses are just finding ways to adapt, like passing costs through to consumers where they can.
So it sounds like a bit of a been there, done that attitude from some clients. They've been navigating this since, 2017?
Seems like it. They've had time to adjust supply chains, find workarounds, and importantly, the bank itself emphasized how diversified their loan portfolio is now.
Right, that balance we talked about.
Exactly. So the actual import-export finance piece is a relatively small part of their overall business today. The direct financial impact of tariffs on the bank itself is probably pretty limited.
Okay, makes sense. So with all this strength capital, earnings, what are they planning to do with it? How are they thinking about deploying that capital strategically?
That's a key question. The bank's first goal, they said, is always delivering top quartile returns, keeping performance high.
Okay, priority one.
Beyond that, though, they are continuously looking at opportunities to build out their key businesses, enhance those fee income capabilities we mentioned.
Like hiring people.
Yeah, including potential strategic hires. And they even mention considering, purchase or acquisition solutions to grow certain areas, bolt-on acquisitions, perhaps.
Interesting. So M&A isn't off the table.
Doesn't sound like it if the right opportunity comes along. And they also engage in opportunistic share repurchases. They still had $241 million left on their current buyback authorization.
So buying back your own stock when they think it's good value.
Exactly. It all shows a pretty thoughtful approach, leveraging their strong position not just to defend, but to actively look for ways to grow and enhance value going forward, not just resting on their laurels.
Okay. So as we wrap up this deep dive then, it feels pretty clear. East West Bancorp delivered a remarkably strong second quarter.
Yeah, the numbers speak for themselves.
Driven by that balanced growth, really robust profitability, and what seems like a very resilient approach to managing risk.
They're navigating what's still a pretty complex economic landscape, focusing on both those traditional banking strengths, but also that strategic diversification we talked about.
Yeah, their ability to adapt and execute really stands out.
It does, whether it's, optimizing deposit costs ahead of rate changes, or strategically growing and balancing the loan book, or even just managing the noise around global trade.
Yeah.
Their execution seems consistently impressive.
So maybe a final provocative thought for you, our listener, kind of mull over after hearing all this.
Let's hear it.
Consider this.
Yeah.
Here's a bank that's deeply rooted in, facilitating the classic American dream through things like home mortgages.
Right, a very traditional banking role.
But at the same time, it shows this remarkable agility.
Yeah.
Navigating these constantly shifting currents of international trade, complex regulations, changing interest rates.
It's quite the combination. It really is. And maybe it's just a reminder that even in established industries like banking, that ability to adapt, to diversify, while still maintaining a really strong foundation, a strong core.
Right.
that's absolutely key to long-term success, no matter what the economic winds might bring.
Well said. Resilience and agility built on a solid base. Seems to be their story right now.